In early 2025, Meta's decision to add UFC president Dana White to its board drew plenty of side-eye, but it's hardly unique. Corporate board appointments have become a revolving door of unexpected picks. The average S&P 500 board member is over 63, yet you'll find everyone from tech founders in their 40s to crypto billionaires in their 20s landing seats, sometimes with little or no relevant experience. More than half of Fortune 500 boards now include at least one member who's never worked in the industry they're supposed to oversee. So what are these people actually doing? To get real answers, we dug into board minutes, pay stubs, and some spectacular failures. Before we get into the details, it's worth asking what boards are even supposed to do in the first place. Theoretical board roles versus 2025 reality. On paper, the responsibilities of a corporate board are straightforward. Provide oversight, set company strategy, and protect shareholder interests. These roles are supposed to create a check on management, ensuring decisions align with the long-term health of the company and its owners. But by 2025, the way boards actually operate has drifted far from these ideals. Most directors now spend minimal time on company matters outside of scheduled meetings. According to the latest Equilar Director Compensation Report, the typical S&P 500 board meets about 4 times a year, with some directors reporting less than a dozen hours of preparation and engagement between sessions. The result is a system where key decisions are often made quickly, with little scrutiny. Analysis from PwC found that 91% of directors vote in line with CEO recommendations on operational issues, signaling that true independent oversight is rare. This pattern isn't just theoretical, it has real consequences. When oversight fails, the fallout can be immediate and costly. Take the case of Kohl's in 2024. CEO Ashley Buchanan was forced out after just 4 months when the board's audit committee uncovered undisclosed conflicts of interest and questionable vendor deals. The company's own proxy statement details how the board's investigation began only after whistleblowers flagged issues, not because the directors noticed problems themselves. Christine McCormick-Day, who chaired the audit committee, later admitted that the board relied too heavily on management's assurances and failed to verify key details independently. Despite these high-profile lapses, board seats remain highly sought after, not for the workload, but for the access and prestige. Appointments are often based on personal connections or signaling value rather than expertise. For example, Meta's addition of Dana White to its board was less about his background in technology and more about expanding the company's network into sports and entertainment. Similar patterns appear at Disney, where a private equity partner with no media experience landed a board seat due to long-standing ties with company leadership. Attendance records show she missed more than a third of meetings while serving on multiple boards at once, a growing trend among S&P 500 directors. Directors frequently juggle several board commitments, raising questions about their ability to provide meaningful oversight. In 2025, 22% of S&P 500 board members serve on 4 or more boards, up from 15% just 5 years ago. This overboarding trend leads to absenteeism and disengagement. The SEC recently issued findings that a significant proportion of directors at major tech firms routinely join meetings late or leave early, yet still collect full compensation and voting privileges. Increasingly, boards rely on management presentations and outside consultants rather than conducting their own due diligence. United Airlines' approval of a new scheduling system in 2024 happened without a single director interviewing frontline pilots, contributing to operational chaos that summer. Boeing's Quality Committee, facing ongoing 737 MAX issues, met just twice during the year and depended entirely on executive briefings instead of independent verification. In both cases, the board's lack of direct oversight played a role in the resulting failures. Technology was supposed to make boards more effective, but the shift to virtual meetings has often made things worse. Directors can now multitask or disengage entirely during sessions. Regulatory filings show that some independent directors at major companies log into meetings from multiple time zones, sometimes participating for only a fraction of the allotted time. Attempts to improve decision-making through AI risk tools have mostly served to justify existing biases. At ByteDance, directors overrode their own AI governance platform's warnings about a new product launch because the flagged risks didn't feel right, leading to a costly market flop. Shareholder representation has also become more symbolic than substantive. Large institutional investors, Vanguard, BlackRock, State Street, control the majority of shares at many public companies and wield outsized influence over board appointments. This concentration of power means that boards often serve the interests of these institutions rather than the broader base of shareholders. Harvard's corporate governance research shows that boards approve CEO pay packages significantly higher at companies where directors have little personal investment in the business. Carnival Cruises, for instance, paid its directors nearly $500,000 each while they owned almost no company stock, yet still approved a multi-million-dollar bonus for the CEO during a period of sustained losses. Conflicts of interest are common. Nearly 40% of S&P 500 boards include at least one member whose outside business receives payments from the company. At J.P. Morgan, the lead independent directors consulting firm has received millions in annual fees, while at Goldman Sachs, the audit chair's law firm handles lucrative legal work for the bank. These overlapping relationships undermine the independence that boards are meant to demonstrate. Efforts to improve diversity and accountability have produced mixed results. The 2025 Equilar Gender Diversity Index shows women now hold 29% of board seats, but only 8% of chair positions. Broader diversity measures, covering cultural background, disability, LGBTQ+ status, and more, are tracked, yet companies sometimes appoint paper directors to meet regulatory mandates with little expectation of meaningful participation. When the SEC required climate expertise on boards, several firms added token environmental specialists who rarely attended meetings. In proxy fights, institutional investors overwhelmingly back incumbent boards, even at underperforming companies. ISS Analytics reports that in 94% of contested elections in 2024, the big funds sided with existing directors rather than activist challengers. This insularity keeps the system stable for insiders, regardless of company results. While boards technically have the authority to remove CEOs, they rarely act unless forced by scandal or external pressure. In 2024, just a dozen Fortune 500 CEOs were ousted by their boards, nearly all following criminal charges or activist campaigns. At major tech firms, independent directors now routinely outlast the CEOs they oversee. The gap between the theoretical role of boards and their day-to-day reality is wide and growing. Yet the rewards for board service remain substantial, even as accountability slips further from view. 2025 board compensation structures. Director pay in 2025 reflects a system carefully engineered for maximum reward with minimal exposure. Board compensation at S&P 500 companies now averages $242,000 per year, according to the latest NACD and Pearl-Meyer report, with the median total package holding steady at $325,000. These figures have risen only modestly in the past year, but for directors serving at the largest tech firms, the numbers climb much higher. At Meta, for example, directors received between $397,000 and $4.2 million last year, combining equity grants, annual retainers, and travel reimbursements. The most sought-after seats go to those already sitting on multiple boards, multiplying the financial benefit with each additional appointment. Compensation structures are highly standardized. About 60% of the typical package comes in the form of equity, usually full-value stock awards that vest immediately or within a year, while the remainder is paid as a cash retainer. The standard annual cash retainer for S&P 500 directors hovers around $130,000, and committee chairs receive an additional $20,000 to $50,000 for their added responsibilities. Most companies have eliminated per-meeting fees, opting instead for these fixed annual retainers. Committee service pays extra only for those in leadership roles, reflecting the expectation that routine committee work is part of the base job. Industry differences in pay remain stark. Directors in the energy sector routinely earn nearly 50% more than their counterparts in healthcare, despite weaker shareholder returns. For instance, Exxon's board approved $350,000 packages for themselves in a quarter when the company lost $12 billion in value. Meanwhile, boards in pharmaceuticals reduced compensation slightly after high-profile drug pricing scandals, yet median pay still reached $290,000. These disparities highlight how board pay is often insulated from company performance. severance arrangements for departing directors have also grown more generous. When Credit Suisse collapsed, outgoing board members received $4.7 million in accelerated equity despite overseeing catastrophic losses. Boeing's directors secured $2.4 million in retention payouts, just before another 737 MAX grounding. These golden parachutes persist because boards set their own severance terms, and nearly all S&P 500 companies now have automatic vesting triggers for director equity upon termination, regardless of circumstances. The disconnect between director pay and company outcomes is difficult to ignore. Tesla's board collectively earned $38 million last year, while facing repeated SEC violations. At Wells Fargo, directors approved $275,000 packages shortly before the company was fined $1 billion for regulatory failures. Research consistently shows that companies paying directors above the market median tend to underperform peers by several percentage points on shareholder returns. Shareholders and activists have begun to push back. The California Public Employees Retirement System, for example, voted against nearly half of director compensation plans last year, a sharp increase from just a few years ago. At Disney, activists forced the board to abandon automatic equity grants after it was revealed that directors had approved a $65 million package for the CEO during a period of mass layoffs. Still, efforts to tie pay to performance often meet resistance. When State Street pressed oil companies to link director compensation to climate goals, boards simply reclassified emissions targets as non-core metrics, sidestepping meaningful reform. The gap between director and employee pay continues to widen. Median board compensation now equals 23 times the average worker's salary at S&P 500 companies, up from 18 times just 5 years ago. At Amazon, the ratio reaches 68-1, driven by large stock grants. Interestingly, firms with narrower gaps, such as Costco and Salesforce, tend to outperform their peers both in profitability and governance scores. Conflicts of interest are frequently embedded in these pay structures. JP Morgan's lead independent director received $6 million in consulting fees from the bank while participating in decisions about executive compensation. Pfizer's audit chair divides his time among multiple boards where his law firm provides services. The proportion of S&P 500 directors with significant financial ties outside their board fees has risen to 63%, up from 41% 5 years ago, raising questions about independence. Defenders of current pay practices argue that high compensation is necessary to attract qualified candidates, but the evidence is thin. High-profile appointments, such as Apple's addition of a crypto founder with no governance experience, who received $485,000 in restricted stock, suggest that prestige or connections often outweigh expertise. Former Fortune 500 CEOs, when added to boards, routinely command 40% higher pay, yet studies show they do not consistently improve governance outcomes. The mechanics of director pay are largely self-reinforcing. Board members frequently serve on each other's compensation committees across companies, creating a network where approval of generous pay packages is the norm. For example, the CEO of one company may sit on the compensation committee of another, and vice versa, ensuring that nearly all director pay proposals pass with little resistance from shareholders. New disclosure requirements were intended to increase transparency, but have sometimes had the opposite effect. As more details about pay components became public, boards shifted compensation into less transparent stock awards. Meta, for instance, now pays directors entirely in restricted stock units that can be cashed out immediately, while some banks introduced performance shares with loose or easily met criteria. Both strategies allowed director pay to rise, even as company performance lagged. Director compensation is closely tied to company size rather than performance. Large firms like Walmart pay directors $260,000 annually despite ongoing operational problems, while smaller, better-run companies like Costco offer lower board pay but deliver stronger results. This size-based formula can create incentives for boards to pursue mergers or acquisitions that increase their own compensation bracket, regardless of whether those moves benefit shareholders. While institutional investors such as BlackRock and Vanguard have started voting against excessive pay at some companies, meaningful change remains slow. The average board tenure has actually increased in recent years, suggesting that the system remains resistant to outside pressure. The current compensation model not only rewards board members handsomely, but also encourages the formation of tight networks among directors. These overlapping relationships set the stage for a deeper look at how board interlocks shape corporate power and influence decision-making at the highest levels. Interlocking Directorates in 2025. In 2025, interlocking directorates, where individuals serve on multiple corporate boards, often across competing firms, remain a defining feature of corporate governance despite mounting regulatory attention. These overlapping board memberships create a tightly woven web of influence, where decision-making authority is concentrated among a relatively small group of individuals. Recent data shows that 37% of Fortune 500 boards share at least one director with a competitor, even though Section 8 of the Clayton Act prohibits such arrangements when they threaten competition. Patterns emerge quickly in these networks. For instance, the CEO of Verizon sits on IBM's board alongside a former BlackRock CFO, who also serves on Exxon's board with a Disney director. That same Disney executive helps oversee Apple, creating a chain where the same handful of people shape strategy across multiple industries. While the number of directors serving on 3 or more Fortune 500 boards has declined from 212 in 2020 to 147 today, the remaining network is still dense enough to influence major sectors. This contraction is largely due to stepped-up regulatory scrutiny, but the core issue persists. Conflicts of interest are common in these arrangements. When Pfizer and Moderna shared a board member in 2023, that director participated in pricing discussions at both companies, which soon announced nearly identical vaccine prices. The FTC intervened, resulting in a forced resignation, but similar cases continue to surface. A Boeing director who also served on Spirit AeroSystems approved contracts for both companies, despite clear supply chain conflicts. Only after a widely publicized safety incident did this relationship come under scrutiny. Regulatory agencies have tried to tighten enforcement. The FTC updated its Section 8 thresholds for 2025, prohibiting interlocks when companies share more than $51.38 million in competitive business. Yet, companies often exploit gray areas, such as appointing non-voting observers or consulting directors, to maintain influence without triggering explicit violations. Lockheed Martin and Raytheon, for example, share a consulting director who attends all board meetings, but technically lacks a vote. The Department of Justice argues that these roles still breach the spirit of antitrust law, but enforcement actions remain limited, with only a handful of cases pursued this year. A new requirement for HSR filings, effective February 2025, mandates disclosure of director overlaps for entities with competitive ties. Early reviews suggest that compliance is inconsistent. 14% of Fortune 100 companies failed to report interlocking relationships in their initial submissions. Even when violations are identified, penalties tend to be minor. Wells Fargo, for instance, paid a $250,000 fine after failing to disclose a director's dual service on its board and that of a fintech competitor. The consequences for competition are significant. When directors sit on the boards of rival companies, pricing and innovation often stagnate. For major airlines share 3 directors, and their coordinated baggage fee increases became public after these interlocks were mapped. Telecom firms with shared directors implemented similar 5G pricing structures within weeks of each other. In the banking sector, boards with overlapping directors approved nearly identical overdraft policies, despite vocal public criticism. Some interlocks verge on the absurd. Elon Musk's brother Kimball sits on Tesla's board and, until recently, also served at Chipotle, which had board ties to Panera's CEO, creating a fast casual governance triangle. More concerning is the role of large asset managers like BlackRock and Vanguard. Their employees often sit on the boards of multiple competing companies, consolidating influence in sectors ranging from consumer goods to energy. Institutional investors are starting to challenge the practice. CalPERS voted against 43 interlocked directors last year, and Norway's sovereign wealth fund blacklisted 17 companies over board overlaps. Still, resistance is uneven. When State Street opposed Coca-Cola's interlocked directors, the company successfully argued that industry experience outweighed antitrust concerns. In pharmaceuticals, 62% of known board interlocks remain, even with clear competition issues. The effect on board culture is measurable. Surveys indicate that interlocked boards experience less dissent. 89% of votes are unanimous, compared to 76% at non-interlocked firms. This trend toward rubber-stamp decision-making contributed to high-profile failures like the Credit Suisse collapse, where directors missed warning signs while serving on multiple crisis-prone boards. Financial incentives reinforce the system. Directors with multiple board appointments earn an average of $487,000 annually, compared to $225,000 for those serving on a single board. The highest earners, such as a former Pfizer executive now sitting on 4 healthcare boards, collect over $1.2 million per year. These rewards encourage directors to maintain the network, even when it undermines independence. Companies often justify interlocks by claiming they bring valuable expertise, but studies show that boards with high connectivity underperform on innovation. Recusal policies are frequently cited as safeguards, yet 78% of interlocked directors admit to participating in discussions before abstaining from final votes. At GM, an Amazon board member joined lengthy talks about electric vehicle strategy before formally recusing himself from the vote. Legal and consulting roles add another layer. McKinsey's former head sits on both Delta and United's boards while the firm receives millions in consulting fees from both airlines. Private equity partners often serve on the boards of competing retailers that pay their firms for advisory services. Since 2020, these arrangements have increased by 42%, replacing true independence with transactional relationships. Regulators are beginning to address informal interlocks more aggressively. The FTC now warns that even consulting and observer roles may violate antitrust laws if they allow access to sensitive information. Recent enforcement actions have targeted tech companies where executives held advisory positions with competitors, but overall, only a small fraction of known interlocks have faced regulatory action this year. Proponents of interlocks argue that they provide stability, noting slightly lower bankruptcy rates among interconnected firms. However, this stability comes at the expense of innovation. Patent filings drop by nearly 20% at companies with interlocked boards. The arrangement tends to entrench incumbents, especially in older industries like energy and automotive, where interlock rates are highest. Shareholder proposals to ban interlocks are gaining support, with 14% passing last year, up from 3% in 2020. But the underlying incentive structure remains unchanged. Board compensation still rewards directors for holding multiple seats, regardless of performance. Without a shift in how board service is valued and compensated, interlocking directorates are likely to persist, shaping decisions at the highest levels. These relationships also affect how much time directors dedicate to each company, raising questions about what time commitment and meeting structures. Time commitment and meeting structures for corporate boards in 2025 look very different from the image painted in annual reports. While company guidelines often claim directors devote 250 to 300 hours a year to board service, actual track time across Fortune 500 firms averages closer to 140 hours. This figure includes not just board meetings, but all committee work, preparation, and informal consultations. Some committees, such as compensation, require a bit more, about 28 hours a year, while risk committees often get by with less than half that. At Tesla, directors collectively spent just 89 hours last year making decisions that included approving $28 billion in capital expenditures. That works out to roughly 12 minutes of board deliberation per $1 billion spent. The shift to virtual meetings has further compressed both the duration and quality of board interactions. Before the pandemic, in-person sessions could last all day, with directors expected to travel and participate in extended discussions. Now, the standard is a 2-hour video call, with directors often dialing in from airports, cars, or even vacation spots. Attendance logs show that nearly 40% of NASDAQ 100 board members join meetings late, leave early, or appear distracted. In one case, a Citigroup director admitted to reviewing unrelated legal contracts during a crucial cybersecurity briefing. Preparation time has also shrunk. Goldman Sachs directors now receive their briefing materials 48 hours before meetings, down from the previous 1-week standard. Most board meetings are dominated by formalities. A review of thousands of board agendas reveals that about 60% of meeting time is spent on ceremonial tasks, approving minutes, endorsing management proposals, and completing required compliance trainings. Only about 10% of time is set aside for genuine debate or strategic discussion. For example, Walmart's board spent less than half an hour discussing a $20 billion acquisition last quarter, but nearly twice as long revising the language of their ESG statement. The phrase "any other business" appears on nearly every agenda, serving as a placeholder for topics that rarely get the attention they deserve. Reported attendance rates in public filings remain high, usually above 90%. However, internal records and anonymous surveys suggest the real rate of full participation is closer to 78%. Disney directors missed nearly a third of committee meetings in 2024, even while collecting full retainers. Boeing's Safety Committee saw half its members absent during critical sessions on the 737 MAX recertification. At Pfizer, one director attended only 4 of 14 meetings last year while serving on multiple other boards. There are exceptions. JP Morgan Chase continues to hold 9 annual board meetings, each averaging more than 5 hours. Their directors report nearly double the average time commitment, at 281 hours per year. Berkshire Hathaway's board, at the other extreme, met just 4 times in 2024 for a total of 12 hours. Both companies have delivered strong financial results, suggesting that more meeting hours do not automatically translate to better oversight. Virtual meeting technology has introduced new challenges. Directors now multitask openly, with some calling in from golf courses or other personal activities. At Microsoft, Q&A sessions were shortened when it became apparent that directors' attention was waning. Some boards have tried to counteract this trend by requiring cameras to be on, but directors often use virtual backgrounds to mask their absence. Data from meeting platforms shows that only about 30% of directors maintain active attention during presentations, and engagement drops sharply for routine agenda items. Preparation for meetings has become increasingly superficial. IBM directors receive briefing books running hundreds of pages, but surveys reveal that most read less than a third of the material. At Amazon, board chat logs have surfaced showing directors asking questions that were already answered in pre-read documents. To encourage preparation, some companies now offer bonuses simply for opening digital materials before meetings. Committee work is similarly uneven. Audit and compensation committees typically meet quarterly for several hours, but innovation or risk committees may meet only once a year. Disney's Innovation Committee, for instance, met just once last year despite major strategic shifts in streaming and content. Across industries, directors spend far more time on pay discussions than on cybersecurity or operational risk, even as breaches and failures have become more costly. Absenteeism remains a persistent issue. Some directors miss multiple meetings due to personal pursuits or obligations to other boards. A United Airlines director attended none of the safety committee meetings during a regulatory crisis, yet still received full compensation. At Pfizer, a director who serves on 7 boards and runs a private equity firm averaged less than 20 minutes of preparation per company each month. The disconnect between time invested and compensation is stark. BlackRock directors earn thousands of dollars per hour of actual board work, even after accounting for ceremonial tasks. At Disney, the hourly rate is similarly high, with directors sometimes approving major decisions faster than they can read the supporting materials. Most directors oppose proposals to track or publish individual time commitments, preferring to keep these details opaque. Some companies have adopted practices to improve engagement. Apple requires directors to complete pre-reading quizzes before meetings, and their sessions run longer than the industry average, with a focus on substantive debate. Microsoft now asks directors to submit written questions in advance. Berkshire Hathaway holds periodic device-free sessions for uninterrupted discussion. Still, these efforts are rare. The majority of boards have eliminated in-person meetings entirely, citing cost and environmental concerns. While a few organizations are experimenting with reforms, most boards continue to prioritize efficiency and convenience over rigorous oversight. The result is a governance environment where major decisions are made quickly, with limited scrutiny or debate. This pattern has contributed to a series of high-profile failures in recent years, as boards miss warning signs and struggle to hold management accountable. Notable 2025 board failures. Several high-profile board failures in 2025 have exposed deep flaws in corporate oversight, providing clear examples of how insufficient governance can lead to damaging outcomes. Boeing's board drew criticism after approving $5 billion in stock buybacks while delaying essential safety upgrades. This decision became indefensible when another 737 MAX incident led to a 32% drop in share price and another FAA grounding. Internal documents later revealed that the board's safety committee had canceled 3 straight meetings in the months leading up to the crisis. Although no directors resigned immediately, 2 were eventually removed after shareholders refused to re-elect them. The collapse of FTX continues to stand as a reference point for governance breakdown. Court records show that FTX's board met only once in 2022, even as the company lost $8 billion in customer deposits. None of the so-called independent directors had any experience in digital assets. One was a university dean who later admitted to never reviewing the company's financial statements. While founder Sam Bankman-Fried faced criminal prosecution, the board members avoided any significant consequences, despite their failure to implement even basic financial controls. Prosecutors described it as the largest case of corporate fraud in a decade, and the board's lack of engagement made it possible. A recurring pattern in these failures is the tendency for boards to treat risk management as a box-checking exercise rather than a core responsibility. At Credit Suisse, directors collected millions in fees while ignoring repeated internal warnings about liquidity problems. When the bank finally collapsed, regulators found that the risk committee had spent more time discussing office renovations than the balance sheet. Silicon Valley Bank's board, composed largely of members without banking backgrounds, approved rapid expansion plans without understanding the implications of rising interest rates. These oversights contributed directly to the bank's downfall. The consequences of board failures often depend on the industry. In technology, boards typically survive even after high-profile missteps. Meta's directors remained in place after several failed metaverse launches, with turnover limited to regular retirements. In more heavily regulated sectors, the fallout is more severe. 3 Pfizer directors stepped down after the FDA cited manufacturing lapses that had been flagged in advance. Wells Fargo replaced its entire risk committee following another consumer protection scandal. In these industries, regulators can bar failed directors from serving elsewhere, a level of accountability that is largely absent in tech. Personal accountability for board members remains rare outside of banking, pharma, and other regulated industries. Boeing's lead director retired with a $23 million payout after the MAX disasters. Only a handful of Credit Suisse directors lost board seats at other companies following the collapse. By contrast, in the automotive sector, Toyota's audit chair was forced off 3 boards in the wake of certification failures. The standard is inconsistent. Life sciences directors often face harsher consequences for smaller failures than their counterparts in tech or banking. Some companies have managed to recover by overhauling their boards and changing governance practices. Intel's board, for example, responded to manufacturing. Missteps by replacing 5 directors with semiconductor experts, introducing monthly inspections, and tying compensation to operational improvements. Within 18 months, the company's foundry unit shifted from major write-downs to securing significant government contracts. Disney's board responded to activist pressure by cutting streaming costs and stabilizing the business after a period of turbulence. Warning signs typically surface before these failures, but boards often ignore them. Boeing's directors skipped factory tours for 3 consecutive years before the MAX issues came to light. At FTX, the risk officer resigned 6 months before the collapse, warning the board about financial irregularities that went unaddressed. Pfizer's directors received whistleblower reports about quality problems a year before the FDA stepped in. Across industries, directors often avoid confronting these issues because it would require challenging management or making unpopular decisions. Attempts to use AI and automated governance tools have not prevented disasters, and in some cases have made things worse. At Credit Suisse, risk algorithms flagged liquidity problems repeatedly, but directors dismissed the alerts as false positives. Boeing's board reduced the sensitivity of its safety AI after it generated too many warnings. At FTX, the fraud detection system was intentionally disabled to avoid noise. These examples show that technology can only help if boards are willing to act on the information provided. The structure of board service itself encourages disengagement. During the Boeing crisis, the average director served on more than 4 other boards. At FTX, board members treated their roles as ceremonial, participating only when convenient. Even after scandals, reforms often fail to address the root problem. Pfizer's new board members still average nearly 3 other directorships each. The more boards a director serves on, the less time and attention they give to any one company. Regulatory responses have been inconsistent. The SEC fined Boeing's board a collective $1 million, less than what most directors earn in a year. FTX's directors faced no formal penalties. In banking, the Office of the Comptroller of the Currency now requires failed directors to undergo additional training before serving again, but such measures are rare elsewhere. This patchwork approach creates little incentive for improvement, especially in sectors where oversight is weakest. Shareholder lawsuits remain the primary tool for addressing egregious failures, but these actions are blunt and costly. Suits against Boeing's board recovered hundreds of millions for the company, but Disney spent tens of millions defending its board from activist claims, expenses ultimately paid by shareholders. The system often protects directors more than it safeguards investors. One troubling trend is that director compensation has begun to reflect the risk of failure. Companies with ongoing governance problems now pay substantial premiums to attract board members, effectively rewarding negligence. Boeing's directors received raises after the MAX incidents because the job was considered more difficult. This incentive structure deters qualified candidates from joining troubled firms, while encouraging those willing to accept higher pay for less accountability. Some institutional investors are starting to take notice. BlackRock now votes against directors who serve on too many boards, and State Street opposes audit chairs with poor attendance records. Yet these policies are still the exception. Vanguard continues to support the vast majority of director nominees at companies with recent governance scandals. Without broader changes from major shareholders, the cycle of board failures is likely to continue. Misaligned incentives remain at the heart of the problem. Directors are paid well for attendance, not for preventing disasters. They rarely face personal consequences for negligence, and most reforms stop short of addressing the underlying issues. Until companies require directors to have meaningful stakes in the business, enforce strict attendance and engagement standards, and hold individuals personally accountable for gross oversight failures, board performance will remain uneven. These failures also raise questions about how much progress boards have made in other areas, including the push for greater diversity in leadership. Board diversity in 2025. Across the Russell 3000, board diversity in 2025 shows signs of real improvement, but the headline numbers often obscure persistent gaps. According to the latest Equilar Gender Diversity Index, women now hold just over 30% of board seats, a significant increase from previous years. More boards are reaching gender parity, with 185 now split evenly between men and women, and the pipeline of new female directors is growing. In Q1 2025, women accounted for 30.6% of new board appointments, a slight uptick that signals steady progress despite recent political pushback against diversity, equity, and inclusion initiatives. Yet, the distribution of leadership roles tells a different story. Women remain underrepresented in positions of real authority. Only 8% of board chairs in the Russell 3000 are women, and the numbers are only slightly better in the S&P 500. Even as women make up about a third of all directors, they hold just 11% of chair positions and 17% of lead director roles. The pattern is clear. Boards are diversifying at the margins, but the top jobs still go overwhelmingly to men. Meanwhile, a stubborn 2% of Russell 3000 boards remain all-male, a figure that has barely shifted in 3 years. While this is a dramatic improvement from the 22.5% seen in 2017, the remaining holdouts highlight the limits of voluntary change. Racial and ethnic diversity has not kept pace with gender. After an initial surge in non-white director appointments following 2020, progress has slowed. The share of new non-white directors fell from 48% in 2022 to 31% by 2024, and black director appointments dropped by more than half in that period. As of 2025, non-white directors hold about 26% of S&P 500 board seats and 23% in the Russell 3000. The drop coincides with increased scrutiny of diversity policies, including the reversal of Nasdaq's board diversity disclosure rules and shifting legal standards that have made some companies more cautious in their approach. Industry differences are stark. Technology companies have made the most visible gains in gender diversity, with firms like Apple and Microsoft reaching gender-balanced boards. However, these same companies lag in racial inclusion, with Black and Latino directors still underrepresented. In banking, some firms have moved faster on racial diversity than gender, while energy and industrial sectors continue to appoint mostly white men. In 2024, 78% of new directors in these industries were white men, and some major companies only recently added their first Black or female directors. The data supports the business case for board diversity. Companies with diverse boards report stronger performance metrics, including higher EBIT margins and fewer regulatory violations. For example, pharmaceutical firms with gender-balanced boards saw 37% fewer FDA violations last year, and boards with a mix of backgrounds handled crises more effectively, opting for pragmatic solutions over prolonged legal battles. Still, the relationship between diversity and performance is complex, and it's difficult to separate cause from effect. Well-run companies may be more likely to invest in diverse boards, but the presence of different perspectives appears to improve risk oversight and decision-making. Despite the progress, tokenism remains a concern. Many boards adopt a two-and-done approach, appointing two diverse directors and then pausing further efforts. At 28% of S&P 500 companies, this has led to surface-level diversity without real inclusion. Diverse directors often wait longer for meaningful committee assignments and can feel excluded from important decision-making. On average, these directors spend 22 months before joining key committees, compared to immediate appointments for their white male peers. Investor pressure has become the main catalyst for change. Large institutional investors such as BlackRock and Vanguard have started voting against nominating committees at companies with inadequate diversity, though their standards are inconsistently applied. Some activists have achieved more direct results, such as the New York City pension fund's push for diversity requirements at nearly 20 portfolio companies. But these remain exceptions. The absence of enforceable standards in the U.S. means that diversity efforts depend largely on shareholder advocacy and voluntary action. Arguments against quotas and mandates persist, often framed around concerns about meritocracy. Surveys suggest a significant minority of directors worry that diversity mandates could dilute qualifications. However, available data shows that diverse directors tend to have equal or stronger credentials, with a higher proportion holding industry-specific certifications. The perception of unqualified diversity hires persists, but it is not supported by the evidence. Some companies are experimenting with broader definitions of diversity. Microsoft tracks cognitive diversity, evaluating how directors approach problems differently, while Amazon measures experience diversity to ensure a range of operational backgrounds. These approaches are rare. Only 12% of boards track anything beyond gender and race. But early results show promise, with companies reporting more robust debates and stronger strategy development. The argument that the talent pipeline is lacking no longer holds up. Women now earn more than half of MBA degrees, and minority representation in law and business schools continues to rise. The real bottleneck is the appointment process. Most board seats still go to candidates found through personal networks, not open searches. Even companies that promote diversity externally, like Goldman Sachs, have taken years to achieve balance on their own boards. Compensation disparities remain. Female directors earn about 18% less than male peers, and the gap widens for women of color. These inequities persist even at companies praised for their diversity practices, signaling that symbolic progress can mask deeper issues. Generational change offers some hope. Directors under 50 are more likely to champion intersectional diversity and push for new perspectives, but they remain a minority. Most boards continue to favor seasoned executives, limiting the pace of change. Global comparisons show that U.S. boards lag behind those in countries with stronger accountability measures. France, for example, mandates gender quotas and enforces them, resulting in higher female representation. The U.S. relies on voluntary action and shareholder pressure, which produces slower, uneven progress. Despite political backlash, the trend toward diversity has not reversed. Companies appear to be quietly maintaining or increasing board diversity, even as public rhetoric shifts. The next challenge is to address tenure diversity, as long-serving directors can contribute to groupthink and slow adaptation. Boards that intentionally mix new and experienced members report better decision-making and earlier identification of emerging risks. The way boards approach diversity, whether as a strategic advantage or a compliance requirement, shapes real outcomes. Authentic inclusion leads to better governance, but many companies still treat diversity as a box to check. The persistence of these patterns is closely tied to the networks and the old boys club persistence. Despite the public emphasis on diversity and fresh perspectives, the reality in most corporate boardrooms is that the old boys club still holds firm control. Board appointments continue to favor individuals with established networks and long careers in business, government, or finance. The average S&P 500 director is over 63 years old, and turnover remains low. Many directors hold their seats for a decade or more, reinforcing a culture where relationships and reputation outweigh new ideas. Traditional appointment channels dominate the process. Most new directors are selected through personal referrals or existing board relationships, not open or merit-based searches. For military contractors and defense firms, the pattern is especially pronounced. Companies like Boeing routinely fill board seats with retired generals and former Pentagon officials. Their value lies less in technical expertise and more in their ability to connect the company with government agencies and regulators. Internal communications from Raytheon have even described board members' main responsibilities as opening doors rather than providing oversight. Claims of meritocracy often break down when examining specific appointments. Dana White's election to Meta's board, for example, was driven by his close ties to political figures rather than governance experience. Similar stories play out across industries. Pfizer's board includes a private equity partner whose firm manages the company's legal work, and Apple's recent addition of a young crypto founder was less about domain knowledge than about leveraging Silicon Valley connections. The underlying message is clear. Access and relationships often matter more than relevant qualifications. Educational backgrounds further illustrate the insularity of boardrooms. A large proportion of Fortune 500 directors attended a handful of elite schools, with Harvard alone accounting for more than a fifth of all board seats. Despite women now earning the majority of law and business degrees, the pipeline to board leadership is still dominated by men from these elite institutions. Data from McKinsey shows that graduates from state schools wait years longer for their first directorship compared to their Ivy League counterparts. Geographic concentration adds to the lack of diversity in outlook. Nearly 4 out of 5 directors live in just 5 major metropolitan areas: New York, San Francisco, Chicago, Boston, and Washington. Even regional companies are increasingly led by board members imported from these urban centers, resulting in a homogenized perspective that often overlooks local needs. For example, Walmart's board has shifted away from Arkansas-based directors, now favoring finance and tech executives from the coasts. This concentration can limit awareness of regional trends and customer bases. Younger candidates and those from outside established networks face significant hurdles. Only a small fraction of directors are under 50, and those who do secure appointments frequently encounter barriers to influence. Younger directors are often excluded from key committees or important decision-making, and boardroom dynamics tend to favor those with longer tenures. Analytics from board software firms show that junior directors participate less in discussions and have fewer opportunities to shape outcomes. Defenders of the old boys club argue that these networks provide stability and institutional memory. However, the data suggests otherwise. Companies with entrenched, long-serving boards tend to underperform their peers, both in shareholder returns and risk management. For instance, Boeing's board failed to address safety concerns for years, with directors who had not visited factories or questioned management practices. Long tenure is also linked to higher CEO pay approvals and less willingness to challenge the status quo. Large asset managers like BlackRock and Vanguard have introduced policies to curb excessive board interlocks, voting against directors with more than 4 board seats. Yet, these measures often result in directors simply holding the maximum allowed, rather than reducing the influence of entrenched networks. Despite public statements supporting diversity and governance reform, these firms continue to support the vast majority of incumbent nominees, maintaining the system's stability. Political and military connections remain a significant factor in board composition. Many retired government officials and military leaders transition directly into corporate board seats, particularly in sectors like defense, energy, and transportation. These appointments are often justified by the need for regulatory insight or government relations, but they also raise questions about conflicts of interest and the true independence of oversight. The revolving door between government and corporate boards blurs the line between public service and private gain. Financial entanglements further complicate board independence. Nearly half of S&P 500 directors have outside business relationships with the companies they oversee, including consulting contracts, legal services, or vendor deals. These ties can undermine the board's ability to provide objective oversight, especially when directors' personal income depends on maintaining favorable relationships with management. Generational change has yet to disrupt these patterns. While startups increasingly promote younger leaders and reward merit-based advancement, large public companies still prefer older directors with established reputations. The disconnect is especially pronounced in technology, where board members are often decades older than the founders and executives they oversee. This gap can slow adaptation to new business models and technologies. Some argue that experienced directors are necessary to prevent reckless decisions, but evidence shows that boards dominated by long-serving members are slower to respond to market changes and more likely to miss emerging risks. Companies with more balanced boards, mixing experience with new perspectives, are better positioned to innovate and adapt, but such examples remain the exception. Activist investors have emerged as one of the few forces capable of challenging entrenched boards. While most companies continue to operate with minimal outside scrutiny, activists have begun to push for change, often targeting underperforming or insular boards. Their campaigns signal a growing recognition that the persistence of the old boys club is not inevitable, and that outside pressure can sometimes force meaningful reform. Activist investors versus boards in 2025. Activist investors have become a central force in reshaping corporate boards in 2025, using proxy contests and public campaigns to pressure companies into making governance changes. Their strategies are increasingly sophisticated, targeting companies where board oversight is weak, executive pay is excessive, or performance has lagged. The approach is direct. Activists identify specific governance failures, present alternative director candidates with relevant expertise, and rally support from major institutional shareholders. Recent examples show how quickly these campaigns can shift the balance of power. Engine number 1 replaced 3 Disney directors after spotlighting the board's approval of $40 billion in streaming losses and the lack of digital media experience among its members. This wasn't a broadside against the entire board, but a calculated move aimed at clear vulnerabilities. Similarly, Bluebell Capital's campaign against BlackRock focused on the disconnect between the company's ESG messaging and the board's actual expertise. Through detailed analysis, they demonstrated that BlackRock's climate-focused funds underperformed and linked this to directors with oil industry backgrounds. The outcome was the addition of 2 new directors, despite BlackRock spending millions to defend its incumbents. Not every activist campaign leads to better outcomes. Some push for short-term financial engineering that can undermine long-term stability. JANA Partners' attempt to force a sale of Kohl's to private equity promised quick returns, but ultimately left the company's share price lower when no deal materialized. Elliott Management's pressure on GlaxoSmithKline to split its business resulted in 2 weaker companies that failed to deliver the expected value. These cases highlight the risk that activists, in their pursuit of rapid change, can sometimes harm the companies they target. Boards have responded by developing new defensive tactics. Many have adopted rapid disclosure bylaws that require activists to reveal their shareholdings within days, reducing the element of surprise. Tenure voting, which gives long-term shareholders extra votes, is another common tool to dilute the influence of activists who accumulate shares quickly. Some boards, like Starbucks, have successfully used these measures to fend off campaigns even when activists controlled substantial stakes. Others try to preempt activist pressure by making visible but limited changes, such as adding a single younger or more diverse director to signal responsiveness. Certain board characteristics make companies especially vulnerable to activist attention. Overboarding, where directors serve on multiple boards, remains a red flag, with these companies facing a much higher rate of campaigns. Boards that approve outsized CEO compensation packages, particularly when performance lags, also draw scrutiny. ESG failures, especially in energy and industrial firms, have become a frequent trigger for activist involvement. In technology, founder-dominated boards with dual-class share structures are frequent targets, as activists argue these arrangements undermine accountability. Institutional investors play a pivotal role in determining the success of activist campaigns. BlackRock, Vanguard, and State Street each take distinct approaches. BlackRock is willing to support activists if there is clear evidence of underperformance or governance failures, but often waits until a campaign gains momentum. Vanguard is more conservative, typically siding with incumbent boards unless activists can demonstrate operational improvements. State Street has adopted policies that limit support for campaigns seeking to replace more than 2 directors at once, citing concerns about instability. This fragmented support landscape forces activists to tailor their messaging and focus on issues most likely to resonate with each major investor. While many campaigns are adversarial, there are examples of collaboration between activists and boards. ValueAct's engagement with Microsoft resulted in the addition of an activist-backed director and the creation of a cybersecurity committee, helping the company avoid the security breaches that affected competitors. DuPont's cooperation with Trian Partners led to a streamlined board and improved strategic focus without a drawn-out proxy fight. These cases illustrate that activist pressure can lead to constructive change when boards are open to acknowledging and addressing their weaknesses. The Tesla compensation dispute brought renewed attention to the role of activists in policing board conflicts. Shareholder challenges to Elon Musk's $56 billion pay package led to a court ruling that found the board had failed in its fiduciary duty by allowing Musk to influence his own compensation. The episode underscored the dangers of founder-dominated boards and the importance of independent oversight. Although Musk's subsequent move to reign corporate Tesla in Texas highlighted the limits of these interventions, the case set important precedents for board accountability. Data on activist outcomes is mixed. While targeted companies often see an initial boost in share price, only about half maintain improved performance over the long term. Activist-driven buybacks and capital returns can deliver short-term gains, but more complex restructurings or asset sales frequently fall short of expectations. The effectiveness of activism depends on the depth of the underlying problems and the quality of the proposed solutions. The landscape continues to evolve. Universal proxy rules now allow shareholders to select directors from both management and activist slates, making all-or-nothing outcomes less common. The SEC has increased disclosure requirements for settlements between boards and activists, encouraging more transparency in how these disputes are resolved. Both trends favor activists who are well-prepared and boards that are willing to engage early, rather than waiting for public battles. A new model is emerging in which activist-backed directors take on longer-term roles, blending the urgency of activism with ongoing stewardship. Directors like ValueAct's Mason Morfitt at Microsoft have demonstrated that this hybrid approach can reduce governance controversies and drive operational improvements. Whether this model becomes more widespread will depend on how boards and activists adapt to each other's tactics. The rise of activist campaigns has changed the expectations for board oversight, but the underlying dynamics between directors and executives remain complex. The next step is to examine how these shifting pressures are influencing the balance of power inside the boardroom itself. Board executive power dynamics. Power dynamics between boards and executives in 2025 reveal the ongoing tension at the heart of corporate governance. The board's formal role is to oversee management, guide strategy, and protect shareholder interests. In practice, most boards still defer to CEOs, with only a minority providing robust, independent oversight. Recent data shows that just over 1 in 5 Fortune 500 boards demonstrate real independence from management. The rest functions somewhere between symbolic oversight and outright acquiescence. Where boards do assert themselves, the difference is clear. At Microsoft, directors dedicate nearly half their meeting time to scrutinizing management proposals, often bringing in independent third-party assessments before making major decisions. This approach recently uncovered accounting issues at 2 subsidiaries, prompting swift action. In contrast, Tesla's board, shaped by Elon Musk's influence, approved his $56 billion compensation package despite obvious conflicts of interest. The deal was later overturned by a Delaware court, highlighting the risks when boards fail to maintain distance from powerful founders. The consequences of these imbalances are tangible. Companies with independent boards outperform their peers, both in shareholder returns and crisis management. Johnson & Johnson's board, with its mix of backgrounds and experience, handled a high-profile legal settlement efficiently, avoiding prolonged litigation. Meanwhile, Boeing's directors missed repeated warnings about safety issues, deferring to management until a crisis forced action and billions in losses. The pattern is consistent. Boards that lack independence are slower to identify risks and less likely to challenge questionable decisions. Industry differences shape these dynamics. Technology companies often concentrate power in the hands of founders, leading to boards that approve ambitious, sometimes reckless, projects with little resistance. In contrast, some established manufacturers have boards that micromanage executives, sometimes stifling innovation. The financial sector offers a rare example of regulatory intervention shifting the balance. Reforms after the financial crisis established independent risk committees at major banks, which have since blocked risky strategies and improved oversight. Board tenure also plays a role. New CEOs face closer scrutiny, but as their tenure grows, boards tend to become more passive. Research indicates that first-year CEOs encounter significantly more pushback, but by year 5, directors approve almost 9 out of 10 management proposals with minimal debate. This complacency can leave companies vulnerable to strategic missteps, as seen at United Airlines, where early skepticism faded as the CEO's track record improved, reducing the board's willingness to challenge new plans. CEOs use several methods to shape board dynamics. Control of information is especially effective. Most directors rely on management-prepared materials, rarely seeking independent analysis. CEOs also influence meeting agendas, sometimes excluding dissenting voices or limiting access to critical data. At Tesla, for example, engineers concerned about safety were kept from presenting to the board for over a year. Social relationships further complicate oversight. Directors may be invited to exclusive events or given perks that blur the line between independence and loyalty. Whistleblower protections remain limited. While explicit retaliation is prohibited, directors who raise concerns can find themselves sidelined or excluded from key discussions. Subtle forms of retribution, labeling someone as not a team player or questioning their strategic vision, discourage dissent. Legal protections focus on violations of law, not on failures of governance, leaving many ethical concerns unaddressed and reducing the likelihood that directors will challenge management even when warranted. There are exceptions where boards have acted decisively. Intel's board removed a CEO who ignored repeated warnings about operational delays. Citigroup's directors clawed back compensation after risk controls were bypassed. These interventions share common elements: a strong, independent chair, directors with relevant expertise, and support from major institutional investors. However, such cases are rare, representing only a small fraction of board interventions. Attempts to use technology to balance these dynamics have produced mixed results. Digital governance platforms and AI analytics can, in theory, help directors evaluate management proposals more objectively. In practice, these tools are often used to reinforce existing biases or justify predetermined outcomes. At Salesforce, leaked communications showed directors manipulating algorithmic outputs to support their preferred decisions. Virtual meetings have also shifted dynamics, sometimes to the advantage of tech-savvy executives who can dominate discussions while less experienced directors struggle to participate. Board agendas reflect these power imbalances. A Harvard study found that directors spend far more time on executive compensation than on forward-looking strategy, a sign that boards are more focused on rewarding leaders than on challenging their plans or setting direction. The incentive structure reinforces this. Directors are well compensated for attendance and loyalty, but rarely for rigor or independent oversight. Calls for reforms, such as linking compensation to governance quality or imposing penalties for oversight failures, remain largely unheeded. Institutional investors play a complicated role. Asset managers like BlackRock and Vanguard have policies to limit director overboarding and promote diversity, but they continue to support most incumbent directors, even in the face of governance failures. These firms focus on compliance metrics, sometimes results in boards that meet surface-level diversity goals while preserving entrenched power structures. The presence of directors who check identity boxes but have close personal ties to executives is not uncommon, masking the lack of true independence. Some governance models outside the US offer alternatives. In Germany, for example, employee representatives on boards provide a natural counterweight to management, sometimes blocking decisions that would harm long-term value. These structures can improve outcomes and reduce the risk of rubber-stamp governance, but remain controversial and rare in American companies. As long as director compensation and appointment processes reward loyalty over scrutiny, power will remain concentrated with executives. Meaningful change is likely only when boards are held accountable for their oversight, whether by shareholders, regulators, or structural reforms. Until then, the boardroom will continue to reflect the same imbalances, with oversight often taking a back seat to convenience and personal relationships. New tools and technologies are beginning to influence how boards operate, promising greater efficiency and transparency. Emerging board technologies. Emerging board technologies have become a defining feature of corporate governance in 2025. AI-driven analytics platforms, digital board portals, and experimental tools like virtual reality meetings are now commonplace in Fortune 500 boardrooms. These technologies promise to streamline decision-making, improve oversight, and provide directors with faster access to information. In practice, their impact varies widely depending on how rigorously boards implement and supervise these tools. AI is the centerpiece of this transformation. Governance platforms such as Boardable and Diligent Intelligence use machine learning to flag risks, analyze management proposals, and generate voting recommendations. The technology can identify discrepancies in financial reports or highlight operational red flags before they escalate. For example, Microsoft's Audit Committee requires every AI-flagged financial anomaly to be independently reviewed, a practice that helped uncover hundreds of millions in accounting errors last year. By contrast, at Tesla, the board's reliance on an AI-generated report for approving executive compensation led to a high-profile court reversal, as directors failed to interrogate the underlying logic of the recommendations. Despite widespread adoption, meaningful integration remains limited. While nearly 9 out of 10 large companies now use digital governance tools, only a minority embed them deeply into board processes. Many directors treat AI-generated reports as a formality, skimming the outputs or deferring to management's interpretation. This superficial use undermines the potential benefits. At Goldman Sachs, directors receive algorithmic briefing materials, but most admit to reading only the executive summaries. In other cases, boards recalibrate AI systems until the outputs align with their preferred decisions, as Pfizer's directors did when their AI ethics tool initially recommended against a planned drug price increase. The limitations of technology become acute during crises. Credit Suisse's AI risk model flagged liquidity concerns repeatedly before the bank's collapse, but directors dismissed these warnings as background noise. At FTX, fraud detection algorithms were deliberately muted to reduce false positives, allowing irregularities to go unchecked. These examples illustrate a recurring pattern. Boards sometimes use technology to justify predetermined outcomes rather than to challenge assumptions or improve oversight. Digital board portals have replaced paper packets, but this shift introduces new vulnerabilities. Platforms like Nasdaq Boardvantage and Diligent now handle sensitive documents, meeting agendas, and confidential votes. However, cybersecurity gaps are a persistent issue. The breach at Lockheed Martin last year exposed weeks of board deliberations about government contracts, revealing that basic protocols like multi-factor authentication were not uniformly enforced. Chevron's board portal was compromised through a director's unsecured personal device, highlighting the risks of mixing corporate and personal technology. As more boards move sensitive discussions online, the consequences of these lapses become more severe. Generational divides further complicate technology adoption. Directors under 50 are far more likely to use digital tools extensively, while older members often rely on traditional methods. This creates inconsistent practices within the same board. At Disney, younger directors use analytics dashboards to evaluate streaming performance, while others base decisions on anecdotal reports from management. Efforts to bridge this gap, such as pairing senior directors with tech buddies, have seen limited success. At Exxon, a director assigned a digital coach still insisted on handwritten votes, underscoring the persistence of established habits. Virtual and augmented reality experiments have yet to deliver on their promise. Meta's board abandoned VR meetings after directors reported discomfort and no improvement in engagement. Boeing's use of augmented reality to visualize factory operations saw minimal uptake, with only a minority of directors participating actively. The technology's novelty has not translated into better oversight or more productive discussions. Blockchain applications are emerging slowly. A handful of companies have begun recording board votes on distributed ledgers to prevent tampering and ensure accurate audit trails. Walmart's adoption of blockchain revealed a director changing his vote after seeing preliminary results, leading to his removal. However, the complexity of these systems limits broader adoption, as many directors require IT assistance to access or use the platforms effectively. A critical challenge is the explainability of AI-driven decisions. Regulators now expect boards to understand and articulate the logic behind algorithmic outputs. The Canadian Securities Administrators have issued guidance on the need for transparency, warning against AI washing, and requiring issuers to avoid exaggerated or misleading claims about their technology use. When Citigroup's board was questioned about an AI-driven trading approval, no director could explain the model's rationale, raising concerns about accountability. Courts and regulators increasingly treat blind reliance on technology as a breach of fiduciary duty. Skill gaps on boards are drawing attention from proxy advisors and institutional investors. Glass Lewis now recommends voting against directors who lack digital literacy at firms with significant technology exposure. Some companies have responded by mandating annual tech proficiency training or linking a portion of director compensation to technology engagement. Intel, for example, requires directors to pass annual AI competency assessments, while Microsoft ties part of its board pay to participation in digital governance initiatives. Still, these measures are not widespread, and most boards treat technology skills as optional rather than essential. The responsible implementation of new technologies also raises ethical and security concerns. Boards must now oversee not only operational risks, but also the biases and limitations inherent in AI systems. The SEC's cybersecurity disclosure rules have expanded board responsibility for digital risk, making it a company-wide issue rather than an isolated IT concern. Directors are expected to ensure that AI tools are explainable, auditable, and aligned with the company's ethical standards. Proxy advisory firms urge companies to recruit directors with genuine expertise in AI and cybersecurity, rather than relying on generalist experience or superficial credentials. Experiments with advanced technologies continue. Some boards have tested digital twins, AI-generated avatars of directors that can participate in meetings or vote in their absence. These trials have raised new questions about authenticity and accountability, particularly when virtual stand-ins behave differently than their human counterparts. Other boards use ghost algorithms to simulate likely outcomes of board votes before formal meetings, allowing management to anticipate objections and adjust proposals in advance. As technology reshapes board operations, companies face growing pressure to demonstrate both transparency and competence. Regulators and investors are demanding clear, factual disclosures about the use and impact of AI and other digital tools. The gap between boards that embrace these changes and those that treat technology as a checkbox is widening, with measurable effects on performance, risk management, and regulatory compliance. These developments highlight that the adoption and impact of board technologies are not uniform. The approach varies not only by company but also by geography, with distinct patterns emerging in different regions. Global differences in board governance. Regional differences in board governance shape how companies set priorities, manage risk, and respond to stakeholders. In the United States, boards are built around the principle of maximizing shareholder value. Directors are typically outsiders, selected for their independence and business acumen, and their focus is often on quarterly results and executive compensation. This can result in quick decision-making and aggressive responses to market pressures, but it also fuels criticism for short-termism and a narrow focus on financial performance. The dynamic is visible in boardrooms where CEO pay regularly reaches hundreds of times the median worker's salary, and where activist investors use proxy fights to force rapid changes in leadership or strategy. European governance models diverge sharply from this approach. Germany's two-tiered structure separates oversight and management, giving employees a formal voice through mandatory representation on supervisory boards. Labor representatives occupy half the seats at major firms, and their influence is more than symbolic. At Volkswagen, worker directors have blocked cost-cutting measures that would have resulted in plant closures, prioritizing long-term employment over immediate profits. Scandinavian countries go further, with Sweden allowing shareholders to vote directly on executive pay and Switzerland criminalizing excessive compensation. These systems encourage stability and consensus, but critics argue they can slow adaptation and make it harder to respond quickly to competitive threats. Japan and South Korea offer yet another model, shaped by business networks and long-term relationships. In Japan, the keiretsu system links companies through cross-shareholding and reciprocal board appointments, which fosters a culture of consensus and gradual change. Boards tend to include representatives from banks, suppliers, and affiliated firms, and strategic planning often spans a decade or more. This structure supports stability and loyalty, but it can also breed insularity and resistance to outside scrutiny. The fallout from scandals at companies like Nissan and Toshiba revealed how tightly knit boards sometimes overlook misconduct to preserve harmony. China's governance model is unique, with the state playing a central role in major enterprises. State-owned companies often have Communist Party committees that review decisions before they reach the board, and even private firms operate under close government oversight. This structure has supported rapid growth in sectors like technology, but it also introduces political risk and limits transparency. In contrast, Australia's "if not, why not" rule has driven progress on gender diversity without imposing strict quotas, resulting in higher female board representation than in many larger economies. These differences become especially clear when multinationals try to operate across borders. U.S. companies expanding into Germany often resist labor representation, sometimes resulting in cultural clashes and failed ventures. Japanese firms listing in the U.S. face pressure from investors to adopt more transparent and independent governance, prompting the creation of special committees or hybrid structures. The challenge for global firms is to reconcile local legal requirements, cultural expectations, and investor demands, often leading to a patchwork of governance practices within the same organization. Board composition and tenure also vary widely. European boards meet more frequently than their American counterparts, but devote less time to compensation. In Asia, directors often serve for nearly a decade, building deep institutional knowledge, but also risking entrenchment. Australia's progress on gender diversity stands out, with 73% of ASX 300 boards meeting or exceeding the 30% threshold for women, while Japan lags behind, still counting dozens of all-male boards among its largest companies. These statistics underscore how legal mandates, cultural norms, and investor activism interact to shape boardroom demographics. Crisis management exposes the strengths and weaknesses of each system. During the global semiconductor shortage, U.S. boards prioritized short-term financial performance, slashing R&D to protect margins, only to lose ground to competitors. South Korean companies, by contrast, invested heavily in capacity, building new factories that later sat idle. German firms, with strong employee representation, negotiated wage adjustments to avoid layoffs, preserving both jobs and long-term competitiveness. The effectiveness of any model depends less on structure alone, and more on the quality of leadership and the willingness to adapt established practices. Foreign directors add another dimension to governance. International appointments can bring fresh perspectives and global experience, but they also introduce challenges in communication and understanding of local markets. HSBC's board, for example, has seen tensions arise from American directors pushing for strategic shifts that clashed with the expectations of British and Asian stakeholders. In some countries, political or regulatory requirements dictate board composition, as in Saudi Arabia, where government ministers sit on the board of Aramco. These arrangements can create friction, but may also drive innovation by forcing companies to consider a wider range of viewpoints. Efforts to harmonize governance standards globally have produced mixed results. While many companies claim to follow OECD principles and international best practices, the reality is that implementation varies widely. France's legal quotas for female directors have increased representation, but critics note that appointments often go to politically connected insiders. Canada's comply or explain diversity rules have led to slow progress, with many firms opting to provide generic explanations rather than make substantive changes. Hybrid models, such as those in the Netherlands, blend elements of shareholder and stakeholder governance, sometimes producing more balanced outcomes. Ultimately, no single governance model consistently outperforms the others. American boards deliver rapid innovation, but are prone to high-profile failures. European boards foster stability and employee engagement, but can struggle with agility. Asian models support long-term planning, but risk groupthink and lack of transparency. The most successful companies often borrow elements from multiple systems, combining accountability, stakeholder engagement, and a focus on sustainable growth. What unites these various approaches is a shared vulnerability to entrenched interests and the risk of cronyism. Whether through personal networks, political appointments, or reciprocal board seats, the mechanisms differ, but the challenge remains the same: ensuring that boards serve the interests of the company rather than those of a select few. As governance models continue to evolve, companies will need to balance transparency, accountability, and adaptability, especially as new forms of ownership and oversight emerge in the corporate landscape. Private versus public company boards. As companies weigh different models of governance, the contrast between private and public company boards stands out. Private firms, shielded from the glare of public markets, operate with a level of secrecy and informality that's nearly impossible for public corporations. Without the requirements for quarterly earnings calls, detailed SEC disclosures, or open shareholder meetings, private company boards can make decisions with minimal external scrutiny. This lack of transparency introduces real risks. Studies show private companies are far less likely to include independent directors, and the absence of external voices can allow unchecked executive control. When Theranos collapsed, its private board's insularity enabled years of fraud to go undetected, while public companies typically face shareholder lawsuits and regulatory probes for even minor disclosure failures. Public company boards are structured around accountability. Regulations like Sarbanes-Oxley enforce practices, such as whistleblower programs and mandatory internal audits. Directors face scrutiny from proxy advisors, institutional investors, and the media. In public companies, regular external audits are the norm, and discrepancies are often caught before they spiral into larger crises. By contrast, private companies are under no obligation to implement similar controls. According to Quotas, less than a quarter of private firms maintain formal whistleblower policies, and more than half of European SMEs lack robust financial controls. Weaknesses in reporting and oversight have real consequences. Private companies are more likely to encounter undetected financial misstatements, operational risks, and governance failures that persist for years. The composition of private company boards often reflects concentrated ownership. Founders, family members, or controlling investors dominate, and formal independence is rare. In venture-backed startups, it's common for current or former investors to fill most board seats, prioritizing financial returns and founder relationships over operational expertise. At SpaceX, for example, the board is composed largely of venture capital backers rather than aerospace specialists, a structure that can speed up decision-making but sometimes leaves gaps in technical oversight. Public company boards, by contrast, are required to include independent directors and increasingly seek out individuals with specific expertise in areas like cybersecurity, audit, or environmental risk. Compensation structures highlight further differences. Public company directors typically receive a mix of cash and equity, with a significant portion tied to long-term company performance. This alignment with shareholder interests is a core principle of public governance. Private company director pay is more varied. Many receive only cash retainers or per meeting fees, and equity is less common unless the company is preparing for a sale or IPO. This can shape priorities. Public boards may focus more on strategic planning and long-term value creation, while private boards often prioritize short-term results or liquidity events. Risk management practices diverge sharply as well. Public companies must maintain comprehensive compliance systems, including internal controls, risk committees, and regular reviews. Private firms, especially smaller ones, often operate without formal risk frameworks. Over half of European private companies lack structured risk management, leaving them exposed to operational, reputational, and financial threats. When private equity firms acquire companies, they may install their own executives as directors, but these portfolio operating partners often act as extensions of ownership, approving nearly all management proposals. This dynamic can accelerate decision-making, but also increase the likelihood of aggressive financial engineering, such as dividend recapitalizations or leveraged buyouts that prioritize short-term gains over long-term health. Succession planning is another area where the gap is wide. Public companies, under pressure from investors and analysts, are expected to have formal CEO pipelines and documented succession plans. Nearly 9 out of 10 S&P 500 firms report having such plans in place. In private companies, succession is frequently ad hoc, especially in family businesses or founder-led firms. This can lead to instability when leadership changes unexpectedly, as boards may not have prepared for smooth transitions or identified qualified internal candidates. The level of external scrutiny is perhaps the most decisive difference. Public boards are subject to ongoing evaluation. Annual board reviews, director elections, and activist campaigns are standard. Private boards, by contrast, rarely conduct formal evaluations, and directors are seldom held accountable by outside stakeholders. The UK's Institute of Directors found that 40% of private companies skip annual board assessments entirely, increasing the risk that governance issues go unaddressed for long periods. Some private companies, especially large or high-profile ones, have begun to adopt public-style governance voluntarily. Firms like IKEA and Bosch have implemented independent audit committees and brought in outside directors, resulting in fewer compliance issues. However, these examples remain the exception. Most private firms resist such changes until external events, like a planned IPO or a crisis, force them to adopt more formal structures. Hybrid models are emerging, but the core trade-offs remain. Private company boards can move quickly and operate flexibly, but this often comes at the expense of oversight and accountability. Public company boards deliver more transparency and risk management, but can be hampered by bureaucracy and short-term market pressures. The evidence suggests that companies with strong, independent boards, regardless of ownership, perform better over time. Yet, without external pressure, few private companies make these changes proactively. The strengths and weaknesses of each model become most visible during periods of upheaval. When companies face sudden challenges or crises, the effectiveness of their board structures is put to the test, revealing whether their governance board responses to crises. Periods of upheaval provide a clear window into how corporate boards actually function under stress. Board responses to crises reveal the depth of their oversight and the quality of their preparation. The onset of the 2020 pandemic, for example, forced directors to make rapid, high-stakes decisions with limited information. Some boards demonstrated adaptability and leadership, while others defaulted to reactive, short-sighted moves that exposed underlying weaknesses. Airlines offered a sharp contrast in crisis management. Delta's board worked closely with unions to implement voluntary buyouts and shift reductions, managing to retain operational expertise and avoid mass layoffs. Their directors took an active role in negotiations, balancing financial constraints with workforce stability. Meanwhile, American Airlines board approved 19,000 immediate layoffs in a single virtual meeting, only to later authorize large executive retention bonuses. The divergent outcomes highlight the importance of informed, engaged directors who understand both operational realities and the long-term consequences of their decisions. Financial institutions, shaped by the lessons of the 2008 crisis, displayed varying levels of readiness. JP Morgan's board, having institutionalized monthly liquidity stress tests, was able to respond swiftly to the 2023 banking turmoil, maintaining stability and even gaining market share. By contrast, Wells Fargo's directors, despite years of post-scandal reforms, continued to approve risky commercial real estate, lending just as the market turned, ultimately requiring another government bailout. The difference lay in the board's willingness to challenge management and insist on robust risk controls. Technology companies face their own version of crisis decision-making. Meta's board, presented with declining revenue, doubled down on a costly metaverse initiative despite mounting evidence of weak returns. Microsoft's directors, on the other hand, pressed for a hard review of underperforming projects, redirecting resources to areas with stronger potential. These contrasting approaches produced vastly different results. Microsoft's stock climbed as it pivoted to AI, while Meta lost billions in value. Both boards had access to warning signs, but only one acted decisively. Crisis committees, often established in the wake of disaster, can be either effective or purely symbolic. After the 737 MAX incidents, Boeing's Safety Transformation Committee met regularly but failed to engage directly with engineering teams or visit manufacturing sites. Their focus remained on presentations and procedural reviews, with little real intervention. Toyota's board took a more hands-on approach when facing accelerator pedal issues, sending directors to factories and suppliers to identify the root causes. This direct involvement not only resolved the crisis more quickly, but also saved billions in recall costs. Board composition plays a decisive role in crisis outcomes. Companies with directors who have operational or technical backgrounds tend to respond more effectively to disruptions than those dominated by financial or consulting expertise. During the global semiconductor shortage, Intel's board, rich in manufacturing experience, accelerated new investments and secured supply, while Qualcomm's finance-heavy board prioritized buybacks and missed critical opportunities. Across sectors, boards with relevant, specialized knowledge outperform generalists when conditions deteriorate. Accountability after crises is uneven. High-profile failures sometimes lead to board turnover, as seen after the collapse of Credit Suisse, where most directors struggled to find new roles in the industry. In other cases, directors retain their positions or move easily to similar roles elsewhere, even after overseeing major missteps. This inconsistency reflects both the insular nature of board networks and the lack of standardized consequences for poor oversight. Certain governance structures are more resilient in the face of crisis. Companies with independent lead directors, for example, tend to recover more quickly, as these roles facilitate more candid board discussions and faster decision-making. In contrast, dual-class share structures often insulate boards from accountability, delaying necessary reforms. Hybrid models, such as oversight committees with genuine independence, have shown some promise in identifying and addressing risks earlier. Sometimes, crises prompt meaningful reforms. Delta's near bankruptcy led to the inclusion of labor representatives in board discussions, improving communication and foresight. By contrast, Boeing's post-crisis changes largely left underlying governance problems unaddressed, with new committees lacking relevant expertise. The distinction often comes down to whether boards honestly assess their failures or simply implement surface-level changes for appearances. Activist investors are quick to capitalize on governance gaps exposed during crises. They study board weaknesses, exploit structural vulnerabilities, and push for director changes or strategic pivots. Their interventions can accelerate needed reforms, but also add pressure and volatility, especially when boards are slow to respond or lack clear contingency plans. Patterns emerge among boards that navigate crises effectively. Frequent meetings, diverse expertise, and clear separation of chair and CEO roles all contribute to better outcomes. Directors with significant personal investment in the company tend to focus more intently on long-term survival. Conversely, boards that meet infrequently, lack relevant skills, or operate as rubber stamps are more likely to be caught off guard and react poorly under pressure. Industry responses to crisis vary. Healthcare boards, for example, have added clinicians to anticipate operational risks, while tech boards remain slow to include frontline engineers. These choices are reflected in performance. Hospitals rebounded quickly after the pandemic, while social media companies continue to struggle with recurring issues. Regulatory responses remain inconsistent. In banking, post-crisis reforms have tightened requirements for board expertise and size, but other sectors lag. Enforcement of governance standards often arrives only after significant losses, and reforms tend to fade without ongoing pressure from regulators or investors. Historical crises, such as the 2008 financial meltdown, continue to inform today's governance debates. The collapse of Lehman Brothers and the subsequent introduction of Dodd-Frank reforms underscored the dangers of weak oversight and the necessity of regulatory checks. Yet, loopholes and complacency persist, and boards often repeat old mistakes in new forms. Ultimately, a board's response to crisis is the clearest measure of its effectiveness. Proactive oversight, honest self-assessment, and a willingness to adapt separate the functional boards from those that merely go through the motions. As the landscape of corporate governance evolves, the ability to anticipate and manage disruption will remain a defining test for boards, one that will shape not only how companies survive, but how they adapt to the next era of business leadership. The future of corporate boards. Looking ahead, the future of corporate boards is being shaped by forces that demand more than incremental adjustments. CEOs are under pressure to reinvent business models as generative AI, rapid economic changes, and shifting stakeholder expectations redefine what it means to lead. The traditional board structure, built for a slower pace and less technical world, is showing its age. Most CEOs now say at least one director should be replaced, citing a lack of readiness for the demands of AI-driven transformation and the need for boards to play a more active role in strategic planning. There is little patience for boards that cannot adapt, especially as 82% of CEOs believe their competitors will disappear within a decade if they fail to evolve. Artificial intelligence is already redrawing the lines of board responsibility. More than half of CEOs are reworking decision-making processes to draw in a broader range of perspectives, not out of preference but necessity. Gen AI exposes inefficiencies and risks that escape conventional oversight, forcing directors to confront uncomfortable truths. Some companies have experimented with digital director twins, AI-powered avatars that analyze proposals and offer recommendations stripped of human bias. These experiments have produced mixed results. At Disney, the digital board member flagged risks and challenged management more forcefully than its human counterparts, prompting the company to end the trial. Regulatory agencies are also watching closely. The Canadian Securities Administrators have warned against AI washing, where companies exaggerate the capabilities of governance algorithms to impress investors. Boards are now expected to understand the AI tools they use, but many directors cannot explain how these systems reach their conclusions, as seen when Citigroup's board struggled to justify an AI-driven trading approval. Diversity remains a persistent fault line. While gender representation is improving, 73% of ASX 300 boards now meet or exceed the 30% threshold for women. Other forms of inclusion are lagging or even declining. Anglo-Celtic directors hold over 90% of board seats in Australia, and Indigenous, LGBTQ+, and disabled representation remains minimal. In the US, the share of new non-white directors has dropped sharply since 2022, with Black directors accounting for just 12% of new appointments. The business case for diversity is well established. Companies with mixed age, mixed gender, and multidisciplinary boards respond to disruption faster and more effectively. Still, old networks and narrow definitions of board-ready talent remain barriers. The 2025 Board Diversity Index calls for broader pipelines and structured mentoring, but progress is slow. Generational differences are sharpening these divides. The average director age remains above 60, even as younger executives possess stronger digital skills and a better grasp of AI's implications. Directors under 50 are 3 times more likely to use digital tools extensively, creating gaps in how boards process information and make decisions. At Disney, younger directors relied on real-time analytics to steer streaming strategy, while older members defaulted to anecdotal evidence from management. Some companies now require annual technology literacy assessments for directors, and proxy advisors like Glass Lewis increasingly recommend voting against those who cannot demonstrate digital competence. Still, most boards have yet to make tech engagement a core expectation, and many directors remain passive participants in virtual meetings. Alternative governance models are gaining attention. Hybrid boards, which blend traditional directors with labor representatives or activist-backed members, have shown resilience during crises. After Delta's near bankruptcy, adding labor voices to the board helped preserve expertise and improve decision-making. German-style co-determination, where workers hold significant board seats, counters short-term thinking and brings operational insight. Some asset managers are testing permanent activist directors who combine investor urgency with a focus on long-term stewardship. Blockchain is being piloted for tamper-proof voting records, though these changes face pushback from directors accustomed to high pay and minimal accountability. Board tenure and turnover are also under scrutiny. In Australia, most directors serve fewer than 10 years, while in the US, average tenure is nearly 9 years, enough to breed complacency. Research suggests staggered terms and mandatory rotations improve board effectiveness, but formal limits remain rare. Companies like Salesforce have reduced average tenure and introduced rotation policies, leading to earlier detection of emerging risks. In contrast, entrenched boards, such as those in Japan, may miss red flags due to overfamiliarity and resistance to change. The skills gap is becoming more pronounced as business models evolve. Traditional boards, dominated by career executives and financiers, often lack the technical expertise needed for today's challenges. Only a small fraction of S&P 500 directors have cybersecurity or AI credentials, even as threats mount. Public companies are beginning to recruit more specialists, but the pace is slow. When the semiconductor shortage hit, boards with engineering backgrounds responded effectively, while those focused on finance missed critical opportunities. Crisis response continues to separate future-ready boards from those stuck in the past. Boards that prioritize resilience, maintain strong relationships with employees, and conduct regular stress tests are better positioned to navigate shocks. Regulatory reforms and outside pressure can drive change, but without internal commitment, improvements are often superficial. The persistence of dual-class share structures, minimal director accountability, and resistance to time-tracking proposals all point to a system that is slow to adapt. Some voices are questioning whether the traditional board model remains fit for purpose. AI tools now outperform humans at certain oversight tasks, but technology alone cannot solve deeper issues of power, accountability, and engagement. The most promising reforms focus on splitting CEO and chair roles, tying director compensation to meaningful equity stakes, and opening the boardroom to broader representation, including employees and independent experts. Change is coming unevenly, and not every experiment will succeed. Some companies are blending stakeholder and shareholder models, while others are doubling down on old practices. The next economic downturn may force more dramatic shifts, especially if boards fail to address the growing gap between what governance could be and what it is. As these pressures build, the real test will be whether boards can move beyond networking and rubber stamping to deliver the oversight and leadership that companies and their stakeholders actually need. As we look at the state of corporate governance in 2025, the gap between what boards are supposed to do and what actually happens remains wide. Directors, on average, spend little time on real oversight, yet compensation continues to rise. Insider networks still play a dominant role in appointments, with CEOs often surrounding themselves with loyalists rather than truly independent voices. Even as public companies face more scrutiny than private firms, both frequently fall short on fundamental governance standards. The push for diversity and inclusion has made some progress, but meaningful change is slow and uneven. Many boards still devote more energy to their own pay than to company strategy, and most major decisions pass with little resistance. These patterns are not isolated cases. They reflect ongoing systemic issues. For anyone invested in these companies, it's worth asking who sits in the boardroom and what qualifies